Right, so to finish up with this chapter, we're just going to discuss one feature of lease contracts that could cause an accounting issue. All right, so we won't go over all these features again. We're just going to go over one issue. Okay, so we're going to go over guaranteed residual values and how they affect the present value of the lease payments and recording the lease asset and the lease liability. So one of our previous examples, the finance lease example, we had a guaranteed residual value in the lease. However, the company expected the residual value to be greater than the guaranteed value. In this case, you don't include the guaranteed residual value when determining the value of the lease liability. However, in the case that the expected residual value is less than the guaranteed residual value, right, the difference between the two will be included in the computation of the lease liability. Let me just point out here, when we're talking about these residual values, this refers to the situation where we're recording the lease asset and the lease liability. Right. Please don't confuse this with the present value test for the lease classification. So for our lease classification tests, if we remember, we did a present value test, where we're taking the present value of the lease payments and seeing if it's greater or equal to 90% of the fair value of the asset. For the lease classification tests, you include the guaranteed residual value in performing the test. Right, for the lease asset, recording the lease asset and lease liability, the test is different. Okay, so let's just go through a quick example of this, and we're going to go back to an example that we saw earlier. So when we're dealing with the finance lease. I put the relevant parts of the example back on the slide. So again, we had two companies, Caterpillar and Sterling Sterling is the one leasing the equipment. So in our past example, it told us it had a guaranteed residual value of $5,000. And Sterling expects that it's probable that the expected value of the residual at the end of the lease will be greater than the guaranteed amount. All right, so in our example, the expected residual is greater than the guaranteed. So we did not include the expected residual value in determining the lease liability. Right. So now instead of this situation, let's say that the expected residual value is 3,000, and again the guaranteed residual value is 5,000. So we have expected residual equal to 3,000, and our guaranteed is 5. All right. So the difference between these two amounts would be 2,000. And since our expected is less than guaranteed in this case, this $2,000 difference will be included in the lease liability. Okay, so to figure out the amount of the lease liability, we would take the present value of the lease payments here. Again, our lease payments in this example was $20,711. And then to that, we're going to add the present value of the $2,000 expected residual value we'll have to pay. Right, and if we went through those calculations, we'd get out to roughly 97,534. Right, this next slide just shows you how the journal entries would differ if we included this $2,000 value in the value of the lease. The slide doesn't really provide too much information. Basic idea is if we included this $2,000 payment, right, when we first record the asset, or the amount we would record it for would be higher, so our lease liability would be higher. And so as a result, if our lease liability and right to use asset values are higher, we're going to end up recording more for interest expense. And then we'll also record more for amortization expense. Everything else, though, stays exactly the same. Don't worry about the slide. I won't ask you about it. And then this last slide, you also don't need to worry about. And in fact, all the slides after this, I'm not going to test you on, so we'll just end the chapter here. So when we include a residual value in the lease liability and asset, right, the first difference is we recorded the lease asset and lease liability at a greater amount. The other main difference in accounting between making a residual payment and not making a residual payment occurs at the end of the lease term. Previously, we didn't make a journal entry for the payment of the residual value because there was no payment. In the case that the expected residual payment is $2,000 and we end up making this $2,000 payment, we would end up debiting lease liability and we credit cash. However, this journal entry up top assumes that our actual payment for the residual value is equal to our expected payment. More likely than not, the actual payment will differ from the expected payment. So let's just assume that Sterling and Caterpillar agree that the fair value of the asset is sufficiently below the expected fair value, such that Sterling must pay an additional $1,000 in cash upon returning the backhoe to Caterpillar on January 1st, 2022. Right, so in this case, we owe $1,000 more than previously expected. So instead of crediting cash for $2,000, we're going to credit cash for $3,000. We're going to, again, debit the lease liability to decrease our liability for this by $2,000. And the remaining $1,000 difference will be recognized as a loss on the lease for $1,000. And then the final thing we're going to go over is just if you have an unguaranteed residual value, it will not be included in the computation of the lease liability. The slides from here on out, I'm not going to cover with you, so you don't need to know those. So we'll just end the chapter here.